just move on to some of the key sectors. Our emphasis this time around will be a lot more on energy, since that's the talking point. Yeah, okay. I'll move on to banking. Our Glenn, our banking analyst, will be presenting.
Hi, Paul. Thanks for that. So the theme for the banks would be strengthening economic momentum. And if you look at the chart on the left of the screen, you can see the PATMI, which is the blue bar, has actually dropped significantly in FY 2020. And this was mainly due to the COVID-19 pandemic. However, we can start to see it return to pre-COVID levels in 2021 and 2022. We therefore expect the 2022 PATMI to exceed 2019's pre-COVID level. And the bank's increased PATMI is largely boosted by the strong economic momentum as we recover from this COVID-19 pandemic and enter a new normal, as well as rising interest rates, which would also increase the bank's NIM and ultimately their profits. Besides the bank's interest income growth, we also expect the bank's fees and commission to grow 22% on a year-on-year basis for full year 2021 and to grow 18% for 2022. Loans growth has also been strong and has shown recovery. We expect loans growth of about 5% on a year-on-year basis for full year 2021. This is more on the conservative side, but we think that there will be an upside to this. Allowances reversion is also expected to continue. Refer back to the graph again. There was a huge dip in 2020 for the PATMI. And with that, there was also a large increase in the bank's allowances to close to 6.7 billion for 2020. We therefore expect allowances to lower to around 1.7 billion for full year 2021 and to 1.5 billion for 2022. We have also looked into the three banks' exposure to China, and as at first half 2021, 30th June, they total around 134 billion, but only account for less than 14% of the bank's total loans. However, this is not much of a concern to us, as we believe that these customers are mostly and primarily state-owned entities and large overseas corporates. For the loans under moratorium, the banks only account a small percentage of their exposure, which is actually less than 3% of total exposure. We're also not that worried about these loans under moratorium, as majority of them are secured by collateral or government guarantees. Lastly, we expect dividend yield to continue to improve. Referring to the chart again, we can see that the dividend paid out would be the red line, and it's closely related to the bank's PATMI. And with PATMI expected to increase, we expect dividend payout to increase accordingly. So therefore, we expect dividend yield of about 4.5% for full year 2021 and of 4.9% for 2022. So thank you. I'll hand over now to Natalie. Next slide. Thank you.
Natalie. You're in control of the slides, Natalie.
I think you are on mute.
Oh no, sorry guys. Hi, thank you Glenn, and good morning everyone. Yeah, okay, sorry. I'm just trying to bring the slides back, but it's a bit lagging right now. Okay, there we go. Okay, so starting off with the property sector, and I'd like to start off with the graph on the left-hand side. This is the price index for the private retail market, residential market. Of course, we see that the lightest blue line here is the HDB resale price index, and versus the landed and the core central region, rest of central region, and outside central region, respectively. So you can see that, you know, especially since start of 2020, end of 2020 to start to the earlier part of 2021, we see a very strong you know, increase in the respective price indices. Okay. And for this, the flash estimate for the third quarter 2021, we have so on a quarter-on-quarter basis, the private residential price index has actually risen by 0.9%. So this compares to 2Q, where the price index rose by 0.8%, and the first quarter, where the residential price index rose by 3%. Okay. And in terms of the HDB resale price index, it has slowed in the third quarter to 2.7% compared to 3% in 2Q and 1Q. Yeah. So it's a slight slowing and a bit of a moderating in the price growth. So in terms of outlook, for 8 months into 2021, that means until August, there were a total of 9,417 units that were sold, and that actually forms 91% of 2020's total sales volume of 10,333 units. Okay, so we are estimating that the number of units sold for the whole of 2021 will be around 12,000 units, 11,000 to 12,000 units. Okay, and okay, so presently, as of 8 months 2021, the number of unsold units in the pipeline is approximately 16,000 units. So this contrasts sharply, back when the unsold units peaked at 37,000 units in the first quarter of 2019, and everyone was a bit more nervous that there might be a bit of an inventory overhang. So now the situation is reversed. Now there's actually a chance that we might actually have not enough inventory, and that also, coupled with the construction delays, has also spurred this residential market. Okay. So this 16,000 units translate roughly to about 1.5 to 2 years worth of inventory at the rate that we are growing. And for the GLS, for the second half of 2021, the government added another 2,000 more units on the confirmed list, another 4,900 units on the reserve list. Yeah. Okay. So overall, we feel that the valuations for the property developers are attractive, and they are currently trading at around 40% discount to NAV. And we prefer developers with a high recurring cash flow, as well as a visible, very visible development pipeline. So we maintain our overweight recommendation on the property sector. Okay, now moving on into the REITs sector. So the graph on the left-hand side, we see the FTSE REIT index, light blue line here. Okay, it has been pretty much range bound, for 2021. Okay, and also the darker blue line here, this is the dividend yield spread. So it's the dividend yield minus the 10-year bond yield. And currently we are at a negative 1.3 standard deviation level. Okay, so dividend yield spread is about 2.5%. And this, of course, is slightly lower, 1% lower compared to the average seen in 2020. Yeah. Okay. So valuations for the REIT sector still look relatively attractive. As mentioned, is at a negative 1 standard deviation level. But if you look at the forward, so the 12 months forward dividend yields, the estimates based on consensus estimates, the forward dividend yield is about 5.3%. So that actually brings the dividend yield spread back up to close to the red line, which is the average dividend yield spread, yeah, at about 3.3%. Okay. So in this table, I just want to point out, there's no interest rate here, but I just want to point out that currently the interest rate levels are still relatively low. We see that the 10-year bond yield is 1.49%. Okay, and that of course compares to the 5-year and the 10-year average, which is around 2.2%, around the 2% level. In terms of 3-month SOR, which is the figure or the metric that we look at when we talk about how much or the cost of debt for the REITs. Okay, we see that the 3-month SOR is at about 0.2%, and that is almost 1 percentage point lower compared to the 5-year average, which was 1.2%. Okay. So now moving on. Okay, sorry, I need to bring it back. Okay, there we go. Okay, sorry. Now bringing back to put things into perspective, how REITs will perform, how REITs have performed, during the various changes in interest rate. So first of all, of course, the rising interest rates will is not good for the REITs. So if you look at the graph on the left-hand side, this is the absolute performance compared. So when we compare the REITs to the STI index, so we see that actually in periods where there are lower interest rate or interest rate cuts shaded in the blue boxes over here, that is when we see that the REITs have actually outperformed the STI, or very noticeably. And on the other side of things, when there were large spikes in interest rates, we saw that the REITs underperformed the rest of the equities. So back to the graph on the right-hand side, what we're seeing right here is the light blue line, which is the price index, versus the 10-year government bond yield. Okay, so the 10-year government bond, this is the, we can see a sort of a correlation here. So every time the interest rates go down, we see a upward movement for the REITs. Okay, so if you follow the arrows, every time there's a downward arrow, there will be an upward arrow. Yeah, so the correlation between the price index and the 10-year bond yield is about 0.3. Yeah. Okay, and also of course, when there are downward movements in, upward movements in the interest rate, which is denoted by the shaded red columns, that's when we see that the price index actually took a hit. Okay, so overall, in terms of borrowing costs, when we did our interest rate sensitivity analysis for the REITs under our coverage, 1% point, because of a lot of our REITs, they actually do employ hedging, interest rate hedging. So based on our calculations, the interest rate impact for DPU, if there were to be a 1% increase in the borrowing costs, that will actually reduce DPUs by about 0% to about 15%. So of course, 1% increase in interest rates is quite drastic, yeah. And a lot of the REITs actually maintain between a 60% hedge to a 100% hedge on interest rates. Okay. Okay, sorry. So okay, so for this slide, this is how the DPUs have performed in FY20. So FY20, of course, we know pandemic year. This was the year where a lot of the DPU growths were negative, except for the industrial, which posted a small 0.6% DPU growth. Of course, this is actually a bit skewed because it was helped by Capital DC REIT. Okay. And moving into 2021, we expect a stronger recovery in DPU. So for hospitality, the one that was most hit, 45.8% recovery, and then followed by a retail, which as we recall in 2020, there was actually 2 to 3 months worth of rent-free or rent rebates that were given to tenants. So that of course took a hit. The DPU took a hit because of that. So we expect a 35% recovery. And for the office REITs, because of the weaker leasing environment, we're actually expecting DPUs to decline slightly by 5.5%. Okay, and then for industrials, a growth from a relatively stable and higher base compared to the rest of the REITs of 8.8%. Okay. Yeah. And diversified is because of the kind of assets they hold. Some hold office, retail. Yeah, so therefore this is a bit of a blended number, 15.9%. In terms of this table right at the bottom, this is how the prices for the REITs, the various subsectors have trended. So when we see that the maximum drawdown, which is the greatest price decline so far, because of the pandemic, hospitality, of course, the worst hit, down by 55% at the worst state. And of course, healthcare was more resilient and industrial as well. And currently, where the prices are trending, hospitality is still the laggard, down by about 36% in terms of price. And we see that the healthcare and industrials, these are the ones that have actually recovered. The share price is actually now trading above the pre-pandemic price, or before the 1st January price. Okay. So overall, in the sector, for the whole REIT sector, we do expect that the deal momentum will continue. And interest rates, as mentioned, even though they are poised to rise, up to about 2% over the next 2 years, we think that the interest rate still remains conducive. We still have about 2 years' time before the SAW is expected to cross the 2% level. Sorry, yeah, okay. So we expect inorganic growth to hasten DPU recovery, and of course the acquisitions that the REITs will make that will result in better diversified portfolios and more future ready portfolios. And not to mention, some of the REITs have been very active in terms of opportunistic divestments, so that will allow them to reap some capital gains, and which then can be used to pad DPUs, yeah, especially as we wait for recovery to kick in. Okay, so now we move into our subsectors, starting off with the office subsector. Okay, in terms of overall, what we are seeing right now is that we still believe that there's a tenant market, and of course, the trends that are in the market right now are right sizing, but this right sizing is mostly done by the banks. Sorry, give me a minute. Okay. So the right sizing is done. Mostly it's just the bank tenants that are right sizing, and most of the tenants are still trying to figure out their space needs. So a lot of them are still working from home or on a hybrid model. So they don't really know exactly how much space they need until they start coming back to the office and start figuring it out and seeing things in totality. So this will actually, what happens with this uncertainty is that the tenants require or desire more flexibility in their leases. So instead of taking outright leases of perhaps 3 to 5 years, or even longer than that, they prefer to have some optionality baked into their leases. So they will probably sign a longer lease of maybe 5 years for 80% of the space, and then for the remaining 20% of space, they will probably take a shorter lease of maybe 3 years or 2 years. So that gives them some time to decide whether or not they want, instead of locking in the whole 100% of space. And some of the tenants also want like contraction or expansion lease terms written into their lease terms. Okay, in terms of absorption in Singapore, the CBD area, so far the first half 2021 net absorption was a positive, was a negative 0.5 million square feet, and this of course was due to some of the right sizing and the figuring out of space needs, and this contrasts with FY20's net absorption for the CBD, which was positive 0.8 million square feet. So last year, what we were seeing was more of a flight to quality in times where the rents actually fall. It becomes cheaper and more desirable for tenants who actually want to be located in the CBD to faster sign their leases. Okay. Overall, there has been a gradual quarter-on-quarter improvement in the Singapore and the US office leasing activity. It's still weak and there's still quite a bit of competition. However, the leasing activity and inquiries has been recovering and growing. So when we talk about supply, we think that this structural decline for the office subsector is actually mitigated by the supply conditions in Singapore. So over the last 5 years, the amount of supply coming onto the CBD area has been about 1 million square feet. Okay, and this over for 2021 and 2022, due to some of the redevelopments that are taking place, for example, at Fuji Xerox, AXA Tower, and Central Mall, this will take off about 1.2 million square feet of office stock offline. Yeah, and so actually that will help with the supply situation. For FY21, the amount of office supply that will hit the CBD is about 0.7 million square feet, and most of this is actually from Capital Spring, which has a relatively high committed occupancy. I think it's around 70%, with another 20% that are in advanced negotiations. So if you look at the graph on the left hand side, this pretty much explains it. We see that the rents, the blue lines, darker blue and the lighter blue lines, they dipped towards the end of FY20, and has slowly start to creep up a little bit, and yeah, and occupancy of course is not that desirable, about 87% for the overall stock. However, do note that the CBD overall occupancy is actually higher because this is a blended amount, and it also includes some of the fringe assets that are not doing so well. So I'll now move on to the industrial subsector. Okay, for the industrial subsector, you know, we see that on the graph on the left hand side, what we're seeing here is, you know, there has been a bit of, sorry, I think I just shifted. Okay.
Actually, you give me control of the slides.
Give me a minute.
Okay, continue. In industrial now.
Okay, thanks, Paul. Okay, so for the industrial subsector, what we see right now is, you know, over the past few years, we have been seeing a slow bottoming out of the rents. However, as of right now, for the retail subsector, the occupancy is the one that has been, you know, sort of recovering quite strongly. You can see that the red line here is occupancy is currently at about 90.1% for the second quarter of 2021. Yeah. Okay. Okay, so in terms of outlook, for tenant profile, you know, these industrial assets, they include business parks, your warehouses, your light industrials, which we see quite a bit of manufacturing taking place at the factories, where there's also manufacturing, and data centers, business parks. Okay, so these assets, right, they attract tenants, they attract tenants that are in the growth driver industries, such as the tech, biomedical, manufacturing, as well as logistics. And so, of course, being in expansion, you know, growth, these are the tenants that will be able to pay better rents, and yeah, these are the ones that are actually, like, you know, looking to expand and wanting more space. So that of course is positive for the industrial sector. In terms of FY21 DPU growth, we're expecting an 8.8% growth, and of course, as mentioned earlier, this is from a relatively stable 2020 level. It wasn't depressed. The DPU wasn't depressed like for the other sectors. So 8.8% growth is largely, not largely, but also a part of it is actually contributed by acquisitions due to the early share price recovery for the industrial subsector. You know, this has aided, you know, acquisitions, you know, making acquisitions more accretive for the industrial subsector. Okay, and that of course will help accelerate this DPU growth. However, despite this positive, you know, macro outlook, you know, where we are currently in the 15 and 14 month of PMI expansion, this might actually, the REITs are actually still a bit cautious. They're cautioning that there might be near-term pressure on the rents. Yeah. Okay, so now we move on to the next sector, which is retail. Okay. For the retail sector, what we're seeing, what we feel is that there is a recovering tenant sentiment. So in the graph on the left-hand side, we see that you know, at the end of 2020, you know, in the mid of 2020, there was actually a sharp dip in the occupancy. However, of course, that has rebounded, and industry occupancy is currently at about 91.5%. Okay. And however, the rental index continues to dip, especially for the central malls, and they're currently, but of course the suburban malls have sort of halted their decline. It was flat quarter on quarter. Okay. In terms of outlook, you know, this is a bit of a contrast compared to the office subsector. So the year to June net absorptions was positive, for 2021, 12,000 square meters versus 2020, where we saw a negative absorption of about 72,000 square meters. Okay, and overall, despite this lower occupancy, industrial occupancy is 91.5. The malls, or the portfolios owned by the REITs, they have outperformed the industry average, maintaining occupancies of above 96%. Overall, we still favor suburban malls. We expect them to remain resilient, regardless whether or not it's a default work from home or return to office, or some or a mixture of hybrid of the both. Of course, this is because of the amount, because suburban malls are located in the heartland areas near the household catchments. So in a work from home mode, the daytime population and in the heartlands has increased, and of course, that will lead to more, necessity spending, your F&B spending on groceries, and even as we shift back to a more work from office mode, that will actually increase the transient footfall at the suburban malls, because these suburban malls are, especially the more prominent, larger ones, they are located near transportation hub. Okay. Yeah. So even as we move back to a more work from office mode, the transient footfall will increase, and that will also help to increase your incidental spending that happens on the way to work, on the way back home from work, or yeah. Okay. Overall, for the central malls, we expect that the uplift for central malls will come only when there's more return to normalcy. So meaning to say, when the safety management measures are sort of eased, and the group size gatherings can be increased back up to maybe 5-8 packs, and of course more events happening and more people going back to work. So that will actually allow more meetup, more gatherings. Okay. Overall, we hear a lot about this increase in risk sharing. So what has happened, for the retail sector is that a lot of the landlords have actually, allowed the tenants to make it more palatable for the tenants, and lower the occupancy cost for tenants. They've allowed or offered tenants leases with higher variable component and a lower fixed rent component. Yeah. So in general, this is supposed to help the tenants, help keep rents in check, in tandem with the recovery in tenant sales, as the economy gradually reopens. Okay, so overall, the variable component for the new and renewed leases ranges about 5 to 20% of the tenant's GTO. However, based on what the REITs are seeing or expecting, they think that the variable component will still be relatively low, between 5 to 7%. Okay. Now moving on to the next subsector. Oh, sorry. Back one slide, please. Okay, sorry. Sorry, this is still for the retail subsector. In these two charts, what we're trying to say here is that we expect that the return to normalcy will lift consumer spending. So if you look at the retail sales index, this retail sales index has been relatively more stable if you look at it, the spending, compared to the F&B services value. The RSI value has actually trended between -3% to -13% compared to respective months in 2019. Yeah, versus the F&B services value index, this was more impacted by the restrictions on mobility and the public's avoidance of public spaces, and just being more cautious in general. So overall, what we're trying to say here is that as mobility increases, that we expect that there will be more gatherings and more events, more purchase triggers. So that will of course help to bridge the gap, bringing the retail sales back up to pre-pandemic levels, and also the F&B value index. So as more gatherings, events are taking place, then we expect that will bridge the gap. Yeah. And this is quite clear because we see that even in the periods where there was circuit breaker, as well as the phase 1 heightened alert, phase 2 heightened alert shaded in the blue columns, that was when the F&B index, service value index, actually dipped. Yeah, okay. So next slide, please. This will be my last slide. Onto the hospitality sector. We feel that the hospitality sector still faces a relatively long road to recovery. We're actually expecting the recovery back to pre-pandemic levels to happen, to 2024, around thereabouts. Okay, the graph on the left-hand side is a relatively self-explanatory. We see that the red line, which represents the international visitor arrivals, is still painfully low, 99% below August 2019 levels, as the international borders still remain largely closed. In terms of RevPAR, revenue per available room, it is still about 61% below August 2019 levels. Okay. And in terms of hotel occupancy, the table on the bottom, you see the hotel occupancy for the month of August is about 55.5%. This is lower compared to August 2020 because because last year this time there was still quite a lot of rooms that were being booked by the government. Yeah, so that of course helped to pad the occupancy, but those rooms were rented out at lower prices. So overall, the RevPAR has improved from August 2020 levels. In terms of outlook, a lot of hospitality owners, they have used this period of weaker occupancy and slower sales to actually start or initiate some of their digitalization efforts, and this should help improve margins. Digitalization efforts is expected to reduce staffing costs, yeah, and eventually, of course, help improve margins. And we might actually potentially see some revenge travels happening in the later part of 2023 to 2024. We also think that there will be a bit of a polarization in terms of branded hotels. So we expect that the large hotel chains and brands, they'll be more popular in terms of recovery, especially as people are more cautious and they try to go for these kind of membership kind of subscription. So the larger hotel chains which have more brands under their umbrella will potentially stand to benefit from this. For the hospitality sector, we see that some of the REITs, the two largest hospitality names, which is your Escort as well as your CDL Hospitality Trust, these REITs have started to branch out, expanding their mandates into longer stay asset classes. And these longer stay asset class include PBSAs, which stands for purpose-built student accommodation assets, as well as the rental housing or multifamily kind of asset types. So these two types of long stay asset classes, they're relatively or say defensive. Even last year, where we know it was a bad year for hospitality, these asset classes have actually maintained occupancies above 95%. So eventually, of course, increasing the exposure to these long stay assets is expected to provide some more stability for the hospitality REITs. And overall, we expect that for Singapore, we may be one of the first countries to benefit from borders reopening, and this is of course due to our high vaccination rates. And despite the recent spike in cases, the severity of the infected individuals is relatively contained. The number of people in the ICU is still relatively low. Yeah. So overall, we still think that Singapore might be one of the first to benefit from border reopenings. Okay, so I think that's all from me. I'll now pass the time back to Paul.
Yeah, thanks. I think we're running short of time, so we're going to have to rush through all this again, like every year. So let me just run through some of the slides. For electronics, for semiconductors, they never had a better time. You can see from the 12-month sales. So these are record sales again for semiconductors. I think if you speak to anyone in semiconductor, they'll tell you that the lead times continue to expand. So right now, global semiconductor sales, the red line is trending around 30% year-on-year growth. But we are a bit more cautious right now because when you look at the typical cycle, some of these past cycles, the semiconductor tends to peak after from trough, that means from the bottom to the peak, about 20 to 30 months. So we already kind of at the midpoint, and we think the rally could probably last until middle of next year before we take another pause. But our preference is still for semiconductors because of the huge fab capex, which benefit companies like UMS and also UMS and also AEM. When we say fab, just think of it like Chartered Semiconductor, if you can still remember. So those are the fabs they're spending on equipment, or TSMC. So this is the big, fastest growing part of the chain right now. For contract manufacturers like venture, we are a bit more cautious because of two things. It's mainly because of the supply bottlenecks. Demand is there, but because of what happened in Malaysia, where they had to close plants, and you can only open if your vaccination, depending on the level of vaccination of your workers. So there's a bit of hiccup probably in the third quarter because of the closures, and not to mention the electricity curbs. So contract manufacturers, we are a bit more cautious for this year because of demand is good, but whether it's just the ability to fulfill the demand. But we still remain overweight on electronics. Okay, we just have a couple of slides on just the energy because that's the main talking point. So you can see that coal prices is also like, you can see this parabolic rise. So coal prices is now all-time high. And if you're asking like why, so let me just explain why is energy so tight, and also I saw some of the questions out there. So firstly, so this is China. So when you talk about coal, it's all about three countries, about China, because China is the one that uses like 4 billion coal. So what happened was, in 2020, this is the blue line is the electricity demand. So you can see the electricity demand was flat, but this year, because of the reopening, because now China's the manufacturing hub of the world, you can see that there's a big spike in the amount of electricity demand in China, but there wasn't enough coal. So you can see that coal production was flat. Then never mind. So China wanted, okay, let's rely on hydro. But hydro also could not be relied because hydro was also down. So hydro is about 20% of the electricity supply. So that's also down 2%. So as a result, there's not enough coal to meet the spike in demand here. So what you've seen is that, and also they're holding back on coal because of all the carbon, their carbon targets. So as a result of that, they have to go into the export market and start buying as much coal as they want. As a side note, the situation also happened in Europe because of they were relying on renewable, which is intermittent, and intermittent means not reliable. So as a result of that, the Europeans also faced a crunch. There was not enough renewable energy, and they also had to go into the coal market. So everyone, the Chinese were chasing, the Europeans were also chasing into coal. So that's one of the reasons. Let me just jump into oil and also palm oil very quickly. So for oil price, of course, we see, and it's well supported by demand supply. So one of the things we track, you can see that oil price tend to move along with inventory levels in the US and production because of a lot of the shale producers are there. So you can see that oil price is moving along with the tight supply or tight inventory. So inventory, if you're thinking whether we can hit the $100 oil price, inventory really needs to go to the 350 and so forth. But the good thing right now is that the US shale producers are starting to turn back on production because it was down the last couple of months. I mean, the shale guys were more interested in paying dividends, pay back your banks, do share buyback. But right now the prices are high, they're coming in. But on the flip side, the worry now is that as we go into a reopening stage, when there's more international travel, demand will still be elevated because you're going to have a lot more demand for jet fuel and so forth. So we think that oil prices will likely stay elevated at this stage, and we're just hoping that it doesn't hit to 100 levels. So the US producers have to respond. Otherwise, there's this risk that the inventories will be very will hit back to their lows of around here, like 350 million. So just referring to Warren's comment on Wilma. So as you all noticed, the last 2 days, there's suddenly a lot of love for palm oil stocks. You can see here, and that's the reason is because palm oil price hit the all-time high of 5,000 ringgit, never before. What has happened is that in palm oil, the stocks are a bit over-owned, the share price. everybody ignored palm oil stocks because it was, everybody thought this was just a one-off, but now the market is viewing palm oil as a proxy to oil, because there's this biodiesel link, because if prices are high, a lot of the palm will be converted into biodiesel. So as a result, you get this link now that palm oil is going to climb, is going to be like a proxy to oil price. What has happened is that, of course, production is also down. This is an inversion, okay? So when production is high, the chart is here, but now that production is going lower, there is also another driver why the demand has been, the price is so high. And if you know palm needs a lot of workers, because these are fruits that are not your like 6 foot or 5 foot for you to just pluck. These are multiple feet high that you need a lot of land power. And because of pandemic, Malaysia is running short of workers, almost 30,000. Well, they think that they can hire back in a couple of months, but we'll see about that. But anyway, the reason is that supply is tight and also it's an oil proxy. So that's why you see this big spike in palm oil prices. The next one is, of course, I saw the questions too. A lot were asking about offshore marine, Semiconductor marine. So as the title suggests, there is a chance. Okay, why we say that is that you can see the order books for Sembcorp and Capital Corp. I'm talking about the yacht side. It tends to move along with all majors capex. So you can see that when capex was high, order book was high. Then when it trended down, you can see that the order books just collapsed because oil price also collapsed at the same time. Then we had a bit of a bounce. Although so we think 2022 there is a chance for the order books of Capital and Sembcorp to recover because all majors are ramping up their capex. So that could translate to an improvement in order books. And after this such a languishing share price, there is a possibility. But the only caveat here is that there's a proposed deal between Sembcorp and Capital Corp. And I think we just worry that Sembcorp might need to raise another round of money to pay that so-called 500 million to Capital Corp. But fundamentally, I think there's a chance that the order books could rebound. As you can see, all majors are starting to turn back out their capital expenditure. Okay, I'll run just one last slide on sectors before we go to the stock picks. Will be on gold. I know there's probably 500 people with different 500 views of gold, but let me just share my 501st person view on gold. So we like to use this chart to talk about gold because you can see that gold price tends to trend in line with the amount of negative debt. So negative debt means that bonds that are paying negative interest rates, mainly in Europe, of course. So it tends to move. So the logic here is that when there's so much negative debt, as a European, why do I want to own this sovereign bonds that I don't earn interest instead of actually pay people? So instead, they switch to gold because gold is a zero coupon. At least I don't have to pay any interest. And you can see that when it started to trend down, the amount of negative debt kind of impact gold. So what we think for gold is to rally back up, we need to see a bear market in bonds, a real concerted. So what we think might happen is that if there's a bear market in bonds, that means if people start to worry that bonds interest rates are going to rise and bond prices decline, the flow, because when we talk about gold, it's all about flow, right? So the flow of money might switch into gold to avoid this huge bear or contraction in bond prices. So that is, we think will only have, that will be the only situation, the scenario where gold could actually rally. Until then, as negative, we think gold price might just be moving sideways unless you have a very strong view that bond prices might collapse or drop quite significantly. So in a way, gold is a good hedge if you have a bond portfolio at least, because I think if bond prices drop, then gold can be the hedge for you. So that's our view on gold since we're on this so-called inflation theme.